What's up, traders? Welcome back to another trader interview. My goal with these interviews is to be able to teach you things about all the aspects of trading so that you are able to learn about all these different things and these possibilities you have as a trader. This week, I'm sitting down with Dr. Ernest Chan to discuss about artificial intelligence in trading, how that can be used, and also the history of AI, how that came to be many, many years ago, how that evolved to today, and what you can do and cannot do with it. Also, how to best use it for your trading. AI is a topic that's really fascinating to me. So without further ado, let's dive right into the interview. Welcome everyone to today. I'm sitting down with Dr. Ernest P. Chan. You are an expert into into actually trading and applying models into trading. So we'll talk about, I feel, AI, software, and things of the sort, quantitative trading. So Dr. Chan, could you tell people who you are and a bit about yourself?
Yes, I started my career at IBM TJ Watson Research Center in the Human Language Technologies group doing machine learning research. That I had a very productive 3 years there. But the interesting thing about that group was that it produced a lot of very high profile quantitative hedge fund managers. I mean, the group has nothing to do with investment management. It has only thing to do is machine learning and natural language research. But for some reason, the algorithms and the techniques that we deployed seems to find a lot of use in managing money. So, there are some high-profile hedge fund managers that grew out of that group. And I too, after 3 years of very enjoyable years there, I too decided to move into finance, not because I didn't like the group, but because I prefer to live in Manhattan rather than in a suburb of New York City. So I joined Morgan Stanley's data mining and artificial intelligence group. That was back in 1997. So in case those who think that machine learning as applied to finance is a recent phenomenon, people have been trying to apply AI to finance since 20, 30 years ago. And Morgan Stanley was certainly one of those pioneers. So after I joined that group, a number of my colleagues decided that they do not wish to consult. That was an internal consulting group, by the way. So a number of colleagues decided to manage their own money instead using the algorithm. So we started a proprietary trading group at Credit Suisse in New York at that time. And after that, I worked for a number of different hedge funds until 2006, where I started to trade for myself. And then shortly thereafter, I wrote books and started my first hedge fund called EXP with a partner in Chicago. It had a few good years, but my partner decided that our AUM wasn't growing fast enough. So he retired from the industry, managing his own money instead of others. And I started QTS Capital in 2011, trading a fairly high frequency Forex strategy, which for about 6 months, it practically has no losing days. And then, so we leveraged 14 times. That was, yes, I know that was a newbie mistake. And we were promptly hit by the first ever Black Swan event, namely the US Treasury debt downgrade. No one in their right mind could have believed that the US Treasury debt would be downgraded, but it did happen. Things can happen. So we were hit by 35% drawdown in that quarter. But so we decided to look for ways to hedge this kind of tail risk. Because certainly our high frequency strategy was subject to such tail risk. And we found one in the following year. And that grew to today's tail ripper strategy. It is a intraday trend following strategy that trade only the E-mini futures, no overnight holdings. And yet it was able to hedge all manners of nasty market regimes. So we had a very good quarter, firstly in the 2015 Chinese stock market crash in the fourth quarter. We had a very good quarter in the 2018 Formageddon, where some of the levered volatility ETF went out, ETN went out of business. And then, of course, this year, the strategy and also our fund had some very amazing returns as well. So the strategy was initially created to hedge our own tail risk, and now it grew to become a standalone product, which many institutional and individual investors have used to hedge their own long beta portfolio as well. And also, it is interesting as well that in the course of improving on our tail hedge strategy, the tail reaper strategy, we went back to, I went back to my own roots in machine learning and try to improve it using the techniques in machine learning. And it's very interesting that, for tail hedge strategy, a lot of people were able to, make money in a crisis. It's easy, just buy put option on the index, and that's it. The question is, how do you prevent loss during better times? And the strategy was able to limit its loss, or in fact make small returns during calm markets because of machine learning. Essentially, we applied a algorithm to make prediction about the probability of each trade in our tail hedge strategy. And if the probability is too close to 0.5, which means it's essentially a coin flip, we would not enter into a position. We would not trade it. And that has saved us from a lot of grief during actually calm markets. When the market is very volatile, you just let it run. But when the market is calm, we let the machine learning layer to feed to our trades. And that system we find to be universally applicable to any strategy. And so we actually started an independent company called PredictNow.ai to capitalize on that, so that we can offer it to other investment managers. And there's no conflict of interest because we are not trying to generate trading signals for these other managers. The machine learning system will learn from the manager's own trading strategy, learn from its own past track record, and and supplement it with external data to improve on their own strategy. So it's a win-win situation. We get to, the managers get to improve the system very easily using our machine learning service. It's a no-code machine learning service. You don't even need to know how to program. And we get to commercialize some of the intellectual property that we developed in the fund as well.
That is very interesting. We have lots to talk about. You mentioned the fact that people were starting to use AI 20 years ago and even beyond that. What did that look like back then compared to today? Is it similar or is it different what people were trying to do back then?
That is a very good question. In the old days, people were very naive, I think. And I certainly was one of those naive people in applying AI to finance. We think, my goodness, the back test is like a sharp of 4. The machine is so smart, much smarter than human. And then we will run the black box and to trade in, day out, and we promptly lost millions using that black box, because what we did not understood was that there is a huge room for overfitting using AI. The machine does not have any sort of intuition. It does not have any context. So it learns every little bit of history in the data if you let it run wild, unconstrained. And those noise are not repeatable. So there are all kinds of patterns that they learn were unique to a particular period or particular year or particular market condition that is not generally applicable. Whereas, and certainly not repeatable in the future. Whereas for a human, they understand a lot of the context. For example, they know that this year, 2020, is a very unusual year. You do not try to learn from the pricing pattern. You're not going to see a 10% daily move, several times in a month going forward. But the machine doesn't know that. So the problem of overfitting or data snooping bias was rampant in those days, and we certainly suffer from that. And that's why for the next 10, 20, 15 years, I have barely touched machine learning. I've barely used machine learning in trading because it was so difficult to keep it from overfitting. But since then, there are advances in both machine learning per se to overcome overfitting, because overfitting is not just a problem for finance, it's a problem for any applications of machine learning. But there are increasing knowledge, a body of knowledge that were developed to overcome that. In particular, in the neural network world, we know that neural network was already developed again 30 years ago. It was not new. And but the problem was mainly again of overfitting. It's very difficult to make it to learn something truly enduring and general and not noise. But in the past decade, Professor Hinton at the University of Toronto developed this technique called dropout that he applied to neural network, and which really reduced significantly this problem of overfitting in neural network. And this really launched a renaissance in neural networks, and which we now call deep learning. I mean, you can effectively say that deep learning, this renaissance of the application of neural network to many practical commercial problem has started with two changes in the current market. One is, of course, the increased computational power. Now we can easily utilize a huge network of cloud computing resource to solve this problem, whereas before we couldn't. We need to buy a supercomputer, which few people have. But the second major advance is the fact that dropout techniques and other techniques related to that have been able to overcome overfitting in machine learning, and that really bring about a huge revolution in the application of AI to many commercial problems. Whether you are talking about self-driving car, or the Siri, or the natural language understanding, and so on and so forth. That is these two major advances have really propelled us to a new technological age, quite frankly, even though machine learning is nothing new at all. And the second advance most pertinent to finance is the realization that maybe some of the best way to apply AI to finance is not to directly generate trading signal, but to actually, for example, a better way to allocate capital among various components of a portfolio, or to generate a probability of profit like what we do, to learn from your own human trading strategy rather than directly from the market, because the market, as everybody knows, has a very low signal to price ratio. If you could find a signal, likely many other people can find it too, and very soon the signal will be arbitraged away. So the signal directly learned from the market is unreliable and have severe alpha decay, very short half-life. So machine learning is have very tough time directly learning from the market. No matter whether you're using deep learning or using reinforcement learning, or all kinds of fancy techniques have been thrown at it, and the result is at least the publicly published result are unimpressive. However, many people, including the one of the giants in this field, Dr. Marcos Lopez-Prado, whose book, Advances in Financial Machine Learning, has been a bestseller. He advocated the idea, in fact, that machine learning can be most profitably applied to learn from the trader's own past history instead of directly from the market. And we adopted that approach as well, and with a lot of success. And so that's I believe is the second advance, that's the second aspect which made machine learning in finance much more powerful today than before. And it is the fact that you do not need to use AI to directly learn from the market. And of course, another factor that would make AI very useful in finance is somewhat indirect, and that is to learn from alternative data. Because traditionally, people use price and volatility as input, very simple factors, earnings and so forth, in a simple linear factor model to make prediction. But it is exceedingly hard for this kind of linear model to take into account alternative data, alternative sources of alpha, like credit card transactions, satellite imagery, or cell phone location data, and so on and so forth. Those data, it's very hard to develop a mathematical model for it, as opposed to developing a mathematical model for prices. You can, but it takes tremendous amount of time, and the data are so heterogeneous. A mathematical model that works for the credit card transaction may not work for freight traffic, and it might not work for satellite imagery. So all those alternative data can really only practically be explored using machine learning. And because of the proliferation of alternative data, machine learning has found a very fertile field to work on and to add value to investment management as well. So that's, I think, is the third leg of the tripod, which propel machine learning in finance to the current level of enthusiasm.
One of the questions that I get a lot since I began to publish things about AI from the guests that I interview is, a lot of people ask, do you think AI will replace manual trading in the future? Do you think that traders manual will have a chance to be able to compete against AI? Or do you think traders will kind of disappear?
Well, I think that ties in with the observation I made earlier, which is that it is not particularly fruitful to apply AI directly to learn from the market. So the most fruitful use from my experience of applying machine learning is to learn from a trader's own investment strategy. So somebody has to create an investment strategy first, and that would not be AI. So I think a human trader is a crucial first step in any investment strategy. It's only after the human used their sense of intuition and context and the understanding about what world we are living in and filter out those signals before machine learning can really be applied. And also the human will be keenly aware of the uniqueness of the situation and also of the potential for arbitrage activities that cause alpha decay. So I'm not afraid that human portfolio manager will suffer a decline in value. It's actually, I think that their value will be, the good portfolio managers will still be in extreme demand because you need them for the machine learning system to learn from. The machine learning system are learning from them, not from the market.
I'll be curious to hear about the process that you take to be able to create systems from the beginning to the system working in the market. How does that look like? What are the steps people would have to take if they want to create systems?
Yes. So we start with a conventional quant approach. And we read widely. There are a lot of academic publications about various arbitrage opportunities in the market. So, practically you can, if you have time, you can spend all your waking hours reading papers and do nothing else at this point. A lot of those papers have been overfitted. A lot of those papers have failed to take into account transaction costs or illiquidity or difficult, many pitfalls. But, I would say 10% of those papers will still remain valid. And from those papers, and also from our own trading experience, we will distill a few trading ideas. They are essentially similar to scientific hypothesis. Let's say Newton observed an apple falling down, and he hypothesized there's a force called gravity that takes the apple below downward trajectory instead of going upward. So, and based on that idea, you test the other consequences. And we adopt a similar scientific process in developing trading strategy. We read paper, we observe the market, and we say, maybe, for example, a recent idea was that, maybe most of the return happen overnight. Or most of the return in the US equity market or other market happen overnight. Is that true? Of course, we will use our own data to backtest that idea, because it's been talked about on the social media and even on published research. And we'll test that idea and we say, yeah, it does work. It seems that indeed most of the return were overnight. But is this a practical offer? Is this something that actually one can exploit? And then you apply transaction costs to that idea. So without transaction costs, that idea may have a Sharpe ratio of 1.5. Wow, excellent. Time to get money into it. But after you apply appropriate transaction costs, you discover that the Sharpe might be dropped to 0.2. Most of that return is so tiny, even though it's consistent, but it's so tiny that if you actually trade on it, it will not generate much return after you apply, account for bid-ask costs and slippage and market impact and so forth, and you abandon it. So that's the process. But eventually you will find some arbitrage opportunity that can withstand transaction costs, and it works in consistently over different regimes, and it makes sense to you, and then you would paper trade it. Even though it might withstand the backtest, there are always things that escape a backtest system alone and will fall apart in paper trading. For example, we used to trade we used to backtest a Japanese small cap strategy that has just amazing consistency, practically no losing days in backtest. And then we tried to paper trade it and even live trade it in small size because it's a little bit difficult to paper trade. And it doesn't work at all. Why? Because whenever we see a good short that should have made tremendous amount of money, the broker won't lend it to us. So we had hard to borrow issues almost every day. All the profitable trades were hard to borrow, cannot execute. Well, maybe we didn't have a very good broker. Probably if we were, a 1 billion hedge fund and, sign up with Goldman Sachs prime broker, maybe we have a different experience, but we aren't a 1 billion fund. And so we are stuck with some prime broker that would not let us borrow stocks. And so all this practical concern would destroy a strategy, even though the strategy is sound and the backtest is not biased or does not have any pitfalls, but the practical aspect of the market have prevented many strategies from earning alpha because of the many other issues such as hard to borrow, stock lending, and borrowing issues. And that is in addition to other operational issues such as margin calls. So some broker during the pandemic suddenly find it necessary to raise the margin 3 times or 2 times overnight without much of a warning. And many strategies that are supposed to be profitable are forced to liquidate because of this kind of haphazard situation. So again, this is not something that you can backtest or even paper trade. Because paper trade, you probably have quite unlimited amount of margin, but live trading is a totally different matter. So after a period of paper trading, we at least eliminate potential look-ahead bias. We eliminate any sort of data snooping bias. Although we couldn't eliminate any unforeseen operational issues, we will go into live trading after a few months of paper trading. And then live trading will reveal whether operational problems exist to prevent the strategy from capturing the alpha. And if it still works, after a few months, we'll scale up. So, but that's not the end of the process. Yes, we might scale up, but there are always periods of drawdown. People will always think that this is purely a flash in the pan phenomenon, and the alpha already decayed. When the strategy enters into drawdown, you never know if this is true alpha decay or is it a regime issue. Is it because it's just we are in a rough patch, or is it because it truly has gone away for good, the alpha? It's very tough call. You never know. So one of the things we always do to the strategy is that whenever, whether it's in a tough patch or not, we are constantly improving it. Whether if improvement is in the execution side, or it is in the strategy side, or in the risk management side. There are 3 angles to look at it. Execution, of course, can always be better. The strategy itself can always be better, adding other inputs or looking for different regime indicators. And then thirdly, risk management can always be better. Whether the risk management is based on machine learning or based on some fundamental insights, they can be applied to any strategy to improve it. So no strategy is static for us. People would say, we want a strategy with a long track record, and say, sure, this strategy has a long track record, like Tail Rippers has a track record since 2012. And they thought, okay, that's good. We want to invest in something that is a long track record. But beware, just because it has long track record doesn't mean the strategy is static, because every quarter we add new features to the strategy. It is never the same strategy. It's like you dip your toe in the river, and it's not the same river any day. So it's a lot of allocators under the mistaken notion that you want to invest in a strategy with long track record. But long track record, first of all, doesn't predict that in the future surely that it will continue to stay that way because of alpha decay. And secondly, you don't want a strategy that is static. You want a strategy that evolves, being constantly improved. And so, and I think we take pride in that process. We never stop research on a supposedly successful strategy, because it may be successful today, may not be successful next month.
And how do you make sure then that you don't over optimize the strategy when you try to improve it? Because I know a few people that are building systems and they add new things, but they come to a point where they added too many things to their strategy. So how do you do that balance?
Yes, that's a very good question. Also, so some of the improvement of the strategy make intuitive sense. So, for example, people would say, "Oh, your tail risk strategy doesn't work when the market is calm." Okay, so well, it's kind of obvious to say that, well, maybe we should add a volatility filter to it so that it doesn't trade when volatility is low, right? That sounds sensible. And you try it, and you can see quickly whether it will work in the past. And if it worked in the past, and it also make intuitive sense, by all means, add it. And we will track it in the future to see if it makes correct decision, this filter, right? And if it doesn't, we will have less confidence in it. But if it works, then it has both proof in terms of concept, proof in terms of back test, and proof in an out of sample test. Good to go. We will keep that improvement, and that applies to many other improvements. Is it sensible? Does it withstand back test? And does it work out of sample? That also applies to machine learning. So in machine learning, we always add features. The machine learning program, again, is not static. Practically every month, our researcher add a feature and test. Well, not necessarily add the feature in production, but at least add a feature in our research program to see if it will improve the prediction. And once in a while, we find a feature that actually improves in backtest, and we'll add it to the production system as well. And again, those features are all sensible. And that's the beauty of the way that we do machine learning, is that it is not a black box. We are not just blindly letting the machine learning system to make trades, because the features are added, are carefully curated by human traders based on their years of experience and observation of market. We don't just randomly, let's add 100 different technical indicators and see which one hit. No, we add indicators that we believe are uniquely suitable for predicting this market, and sometimes they work.
So if I understand it well, that means the AI will give you some ideas of things to modify or improve, and you could decide if you want to use them or not.
Yeah, there are actually two ways to use AI. One is just like you said, it's called a process of feature importance ranking, and we wrote a paper on it. The paper will be published soon. Actually, it's available on preprint form. It's called can't remember what it is called. What features to select? If you Google my name, Ernest Chan, you will find that paper online. The idea is that machine learning can offer two things. One, it is allow you to pick what variables are important to your strategy. And that once you pick it, you don't have to use machine learning anymore. You can add that feature directly into your strategy. Let's say machine learning pick volatility to be an important determinant of the profitability. And you say, well, that makes sense. Really, you shouldn't trade this tail hedge strategy when volatility is low. Well, you might just directly add that as a filter. You don't care about machine learning anymore. Anybody know how to add a volatility filter to your strategy? That's one way, and that depends on features importance ranking, which is a topic of active study, and that's actually what our paper is about. The second way is, of course, automatically include only the top features in your predictive program. And that is the other way that we have applied feature selection to, and using machine learning to. It is, we don't necessarily have to take those important features and put it in our base strategy, but we can simply automatically only include the top strategies as top features in order to build a model.
Do you feel like investors are comfortable with investing in AI, or do you feel like they have a resistance to prefer maybe investing in something manual?
There have been a increasing and tremendous increase in investor interest in AI funds. In fact, a recent study, I believe by JP Morgan, have noted that funds that utilize machine learning has vastly outperformed those that does not in recent years. That is a objective study. JP Morgan is basically a sell side firm. They don't care if you trade by machine learning or not. So they make the same amount of commissions or other fees. So we have seen really much less resistance to applying machine learning to fund, especially the way that we use it, because our fundamental idea is very simple, it's very intuitive, and no one will dispute that. But the machine learning is used to enhance the basic investment strategy, make it much harder to copy. For example, anybody can do trend forward. Buy high and sell higher. Right? How tough is that? Any high school student can trade a portfolio with that kind of technique. But are you able to select 170 features that monitor global markets in order to decide how much to allocate to a trade, or whether at all today we should trade at all? That's not something that any 17-year-old can do, even though she or he might have some programming experience, because they may not have the necessary market experience. Because again, these 170 features are not random. We don't just throw in every single technical indicators and hope that it works. They are carefully curated by human traders. So the combination of human intelligence and artificial intelligence is powerful in this area of commerce, as in others. For example, people talk about self-driving car. Actually, it is much safer if the car will work with the human driver. You hear about story about Tesla, their radar or computer vision couldn't differentiate a truck that has been painted white. They think that it is just a sunlight, and they just drive straight into it. It's a very sad story. But we take the same attitude towards applying machine learning to trading. We don't take everything. We have a human trader behind every machine decision. We don't let the machine just take over completely and we go on a beach in the Bahamas. No, we are watching the trade every day. Maybe at least one, if not three of us, are watching the trades every day to make sure that the machine doesn't make crazy decisions. And that's the same principle that I believe should be applied to autonomous vehicles, is that you should not just say that the human is useless, let's not touch his judgment. No, the human judgment plus the machine judgment is what makes the driving experience much safer. We do want to get rid of that layer of risk management, in my opinion. Of course, many self-driving car producers totally disagree.
Where do you think AI is going right now? Because we already have a lot of progress. Like we mentioned before, we went from 20 years ago to now, it's different. And what do you think is the next step in AI?
The next step never, the progress never stops. So the next step is like next hour, next day. So it's not like there's a sudden quantum jump that we're waiting for. There is always more alternative data to learn from that requires machine learning. There's always better technique to select features. So originally, there's only one feature selection method. Now we have at least three, probably more, that I haven't even heard of. Techniques of feature selection improves. If you keep up with the machine learning literature, essentially you cannot possibly finish reading everything. Even you devote your entire waking hours to reading machine learning papers, or even machine learning applied to finance paper, you will never finish them. So progress is happening at a rapid clip every hour, not every month, every hour. Because as I said, the number of paper published is impossible to keep up. No one can keep up with it. So you can imagine that the next step is right now. It's in the next hour there will be several new papers that are published, and one of them might make a major advance in this field.
That's amazing. And someone being, let's say, new to AI, where would you recommend them to kind of go to start learning about things?
Oh, there are a lot of very good books in this area. As I said, you will not be able to finish reading everything. So let's start with the most pertinent books. I would say that for quantitative trading per se, before you go on to machine learning, of course, I would recommend my own books, the 3 books that I've written, starting with quantitative trading, and then algorithmic trading and machine trading. And my books also reference many other highly readable books and blogs and articles as well. So it's not just my own ideas. I make an effort to make them educational and point people in different direction in terms of learning resources in the books. And then in terms of the financial machine learning, I mentioned Dr. Marcos Lopez de Prado's book. They're highly readable, highly acclaimed. And then he recently published a follow-up on that book. I believe it's called Machine Learning for Asset Managers, and which go into some of the even newer techniques. As I said, research happen every hour. So just maybe 2 years after he published his first book, already there are many improvements to the techniques he discussed in the first book. And then I'm sure that next year, there'll be another book that push the boundary forward, another major step. So, but I would suggest starting with those books. And actually, one of the best way to get a list of all the best books in this field is to visit my blog, epchan.blogspot.com. I have a book list, a recommended book list, and those are the books that I read and love and find them very useful. Not just my books, obviously, but many books in the quantitative finance world that I found highly valuable. And so readers can just go to my blog and check them out.
Perfect. We'll make sure to put a link in the show note for the podcast and on the video as well in the description for people to check it out, all those books. Definitely recommend people to read your book as well. Like you said, Quantitative Trading. So it's going to talk about things like how to evaluate strategies, how to back the strategies the right way. So definitely useful for people that are looking into kind of starting to be more, I think, data-driven and kind of starting that world of using data to trade. So definitely a good book on that.
Thank you.
So where can people find you if they want to connect with you or reach out after this interview?
It's very easy. My email is on epchan.com. So go to my website, my name, my initials, EP, and then my last name, Chan, CHAN.com. You will find my email there and all the resources that I put together for traders, experienced or new, to get involved.
Excellent. And Ernest, what are your goals for the future in trading or outside of trading?
Our goal is to develop more strategies, not just tail hedging, but in all direction. Volatility trading has been one of our focus. So we have a volatility trading strategies that doesn't trade very often. So we are undertaking an active effort in moving into volatility trading, involving either volatility futures or options. We find it is an extremely fertile field for algorithmic and machine learning approach in this field. And that's in terms of the investment and management business, that's our current focus. And then, of course, for the machine learning focus, as I said, our new company, PredictNow.ai, is gaining a lot of traction, surprisingly fast. I just published a blog post about maybe a week or so ago, and it was already, there's a bit of a buzz out there on using this service because it's so easy to use. So that's going to be also the secondary focus that we have, which is to commercialize our AI technology that we use in-house with a lot of success.
What is your main motivation to keep creating strategies and keep working on AI? What motivates you to go beyond?
It's a very intellectually exciting field. I mean, but my education was as a theoretical physicist, so I have not done a single day of research in theoretical physics after I got my PhD, unfortunately. But because at that point I already know that my passion is in machine learning and statistical pattern recognition, and has been my passion even while I was a physics graduate student. I always try to look for projects in statistical pattern recognition because it's so very close to statistical mechanics. A lot of the major advances in neural network were done by physicists. Dr. Hinton, for example, undergraduate degree was in physics, not in computer science. So so that has been my passion ever since graduate school, machine learning and statistical pattern recognition. And there's no more challenging problem for statistical pattern recognition than the financial market, as everybody has come to recognize. It's much harder than driving car, much harder than playing Go, much harder than responding to your Siri queries on your iPhone. It is truly one of the toughest, if not the toughest, machine learning challenge. And I'm very excited to be part of it. And even to this day, after 20 years of research.
That's very awesome to hear. And it's been a really good discussion, really interesting for me to learn these things. And I hope people like it as well. So I suggest people reach out to you, connect with you on your blog, and also read the book we discussed. And thank you for your time, Ernest. I appreciate it. And we'll hopefully talk soon.
Thank you very much for inviting me. It's my pleasure.